What do the terms alpha and beta mean in investing? Hi there. In today's Investing Basics, we're going to look at the terms alpha and beta. We'll explain what these terms mean and how the TipRanks Smart Portfolio can help you understand the alpha and beta of your investments. Alpha and beta offer different ways to evaluate the performance of a stock, fund, or portfolio. Alpha describes an investment's performance when compared to a benchmark such as the S&P 500. The term is often used to describe an investment strategy's ability to beat the market. If you hear the phrase alpha beating strategy, this means that historically, the strategy has beaten a benchmark. For example, TipRanks has a stock research tool that uses the informative buy trades of corporate insiders to help investors search for stocks. It offers alpha beating strategies based on insider transactions. An alpha of 1 means an investment has outperformed its benchmark index by 1%. An alpha of -1 means the investment has underperformed by 1%. If the alpha is 0, its return has matched the benchmark. Beta, on the other hand, is a measurement of risk and volatility in comparison to the benchmark, such as the S&P 500. An investment with a beta of 1 has almost identical price activity to the benchmark. An investment with a beta above 1 is more volatile than the market. An investment with a beta below 1 is less volatile than the market. An investment with a negative beta is inversely correlated to the stock market. When you use TipRanks Smart Portfolio, you will see a full analysis of your portfolio, including the beta of your portfolio, as well as the average beta of other investors, including the top performers. It also shows you your most volatile stocks and their beta. You can also see how your portfolio compares to the S&P on a monthly basis. If you haven't yet opened a TipRanks Smart Portfolio, give it a go right now and let us know what you think